Hi, good morning, good evening, wherever you are. Welcome back to the Dummy Investor channel. This is a place where I periodically share my perspective on investing in the stock market or the equity markets, mainly for fellow retail investors. So, you know, please do spend time going through this video and provide your feedback. If you like what you saw, please do press the like button and please do subscribe to the channel before we proceed ahead. Now, for this episode, as we speak, of course, the markets today seem to be in consolidation mode. I mean, the Nifty ended flat, was predominantly down throughout the day, and then later on it caught up. Sorry. And uh, I thought it's a good time to just take a step back and just scan the entire Nifty universe of all companies, break them down by sectors and their relative market capitalization and see where each sector stands in comparison to each other on relative price to earning multiples. Now, please do note that P multiples can be optically deceiving, so it's just one of the parameters that can be used to get a sense or pulse check of where each sector stands in terms of relative valuation. But of course, one needs to do a more uh, further analysis to identify sectors which might be undervalued currently by the market. The second thing, of course, what this episode attempts to show is that how certain sectors tend to get hijacked by one or two large or very large market capitalization companies, and hence their overall weight in the whole Nifty universe increases. So it's important to just keep that in mind and also understand whether if we remove these large, ultra large companies, there could be opportunities to identify, small to medium sized companies which are probably relatively undervalued, have a good growth story going for them just based on economic tailwinds, and see if we can invest in them at the right entry price and hold on to them. So let's just not waste any time and let's just quickly go ahead. Um, Now, what I did was I relied on the IFL site to just get an extract of the Nifty data. This is, I think, as of yesterday or maybe end of last week. So it's fairly reasonably accurate in terms of where we are right now. And what you see on the screen right now is, of course, all the Nifty defined sectors sorted by the size of their market capitalization. And you also see a market cap weight. This is something which I added additionally just to show, you know, how big a sector is in terms of the current market capitalization. Now, of course, there are many more sectors outside of this, but this is what I could fit into the screen. And broadly, these 32 sectors that you see on the screen constitute roughly 93 to 94% of the market cap currently. So I think it's a fair representation of the broader Nifty universe. Now, additionally, what you see on the screen are, of course, standard columns like price to earning multiple levels, what's the trailing 12-month EPS value, number of outstanding shares, so on and so forth. But I've added two additional columns. One is average market cap, which is basically, dividing the overall market capitalization by the number of constituting companies. It just gives a sense of, what's the average market cap of the sector, and we're going to come down to that in the next segment of the video as well, in terms of trying to differentiate between the two views. There's also an additional column called earnings yield. Now, these earnings yield is, of course, an inverted PE multiple. And the way I personally use earnings yield is I benchmark it against the current long-term, government of India interest rates, or the 10-year yield that the market is commanding, and it usually acts as a good reference check. For example, any stock or any sector which has a earnings yield which is higher than the 10-year long-term interest yield on government securities would probably be in the value zone just as a reference check. But of course, the idea is not to take this dogmatically or apply it blindly, because as we'll see, certain sectors and certain industries and certain companies tend to command a higher price to earnings multiple historically consistently. Obviously, just scanning the landscape based on price to equity, price to earning multiple, what you see is, certain sectors coming up in red, and this is just relative, distribution of value, right? And certain sectors seem to be obviously looking optically very expensive, which are the ones marked in red, and certain sectors are looking relatively undervalued or reasonably priced, let me put it this way. And it's understandable why that is the case. For example, if I take FMCG or pharma, it's a very interesting story. FMCG, of course, comprises of some of the well-known brands and well-known global reputed companies like Unilever, Nestle, um, Britannia, Growth Edge Consumer. And traditionally, FMCG sector has had historically a very high price to earning multiple. But then even in this sector, the idea is to determine whether the current P levels for say FMCG is relatively higher than its historical multiples. Similarly, if I were to take pharma, pharma is another interesting case. 5 years back in pharma, the price to earning multiple of the Nifty Pharma Index was around 58 PE. And in the 5 years since, from December 2015 to December 2020, the Nifty Pharma Index has corrected significantly and it is now down to 35 PE. Does that mean it is relatively um, more in the value zone? It depends, because we'll have to sort of probably look at historical numbers over, say, 10 years. But clearly, it's less expensive as it was as compared to what it was 5 years ago, and we've seen anecdotal evidence of that, in the sense, pharma companies not doing well and contracting till this year, when suddenly they've started expanding post the COVID situation, and how everybody's anticipating pharma companies are going to do well. Now, these two sectors obviously are considered to be core defensive sectors in any portfolio, FMCG and pharma, in the sense that they are consistent performers. Generally, they will deliver on an average, 10 to 15% EPS growth, which is reflected in the stock performance. And so they are not like outright performers. They won't give huge swings year on year, but they are consistent performers. Whereas if you see some of those sectors which are marked in green, like for example, refineries or let's just take infrastructure, steel, these are considered traditionally to be cyclical industries. And cyclical industries, by definition, are cyclical in nature, which means that at certain times in the economy, these industries will obviously be having a lot of tailwinds in their favor in terms of GDP expansion, the sector doing well. But at the same time, there are phases in the economy where when these sectors don't do well. And typically, where retail investors get caught up and end up losing money is when they confuse the GDP market cycle of these sectors to the sort of stock market cycle. Uh, there is either a leading effect or a lagging effect, in the sense these industries, if you were to say start from the bottom, these industries would be completely beaten down by the market or completely ignored. As a result, they will be looking very attractive from a valuation standpoint, and rightly so, because the market would have seen that these companies have not historically been performing or are taking on a huge debt or not having great earnings expansion as compared to some of the other sectors. However, as these sectors start picking up, as the wheels of the economy keep turning, usually either the market is late to catch the trend and hence there is a PE contraction and then followed by an expansion in price to earnings multiple, or vice versa. The market anticipates that cyclical industries are likely to turn around the corner, and so there is an outright PE expansion followed by the earnings coming through. Where retail investors get caught up is when they probably buy the stock of these cyclical companies at the peak of their valuation based on their current performance. Whereas for cyclical industries, we don't necessarily need to look at what has happened in the recent past, but what's likely to happen going forward, 2 to 3 years down the line. Now, another interesting thing, of course, is I would want to call out public sector companies. Public sector companies typically are relatively undervalued as compared to their private counterparts in any given sector. And that is also something which comes out very clearly in some of the uh, public sector dominated sectors, like, for example, power generation and distribution, and to a lesser extent, oil and gas or refineries as well, right? And so it's important to just get a sense check of which sectors are relatively looking optically undervalued. Like I mentioned before, price to earnings is just one of the ways we look at it, and one needs to do a further deep dive into analyzing the underlying companies in a sector and what's their balance sheet quality, what are their growth prospects, so on and so forth. But I think this gives a good macro top-down view of how each sector is performing, right? So um, what I did, let's just move on. What I did next is, of course, sorted this list of sectors by average market capitalization. And clearly, one thing that stands out is that refineries becomes number one, and that's predominantly because of the weight that Reliance carries in this sector. Reliance alone would be close to, I would say, 80% of the entire market cap of this sector. So it can be a bit misleading, and that's why the average market cap is high because there are only six underlying companies in this sector. But new names come up, like for example, paints and varnish. Um, Again, very expensive. Insurance, um, automobile. Automobile is another interesting story because it everybody's saying it's a beaten down sector and so on and so forth. However, if you look at the price to earning multiple of the sector as such, it is fairly high. Most of these auto companies are already having a high price to earning multiple, and that's because the market has already factored in a recovery, so the prices run up already. So if you're looking to buy auto companies at this point in time when the prices have already run up, um, might be worthwhile to just do a second check and see whether it still makes sense to buy these companies or not. um, Similarly, if you take, say, for example, e-commerce companies or gas distribution companies, they seem to have a relative price to earning multiple, which, either shows that the price has already run up and the earnings are yet to catch, or, the earnings have dropped off significantly. And that could indicate that the sector is facing some economic headwinds, right? Now, again, like I said, it's important to just validate this against earnings yield. Banks currently, on the whole, I have an earnings yield of 6.69%, which is, I think, quite fairly priced. But then the picture can be misleading because some of the private sector banks will be having a higher valuation as compared to some of the public sector banks in the sector. So maybe PSU banks could be a value play if for pure play value investors, and so on and so forth. Healthcare, again, very expensive. Everybody is betting on healthcare as something that will pick up given the COVID situation we are in. However, most probably the prices have run up. So I think the broader big picture view is that because the Nifty has run up so much, the underlying sectors, not just within the Nifty 50, but broadly in the Nifty universe, this is a list of some 1700 odd companies, have also run up. And it's it begs the question, where can we invest now? Where is value in this market, and how should retail investors approach this? So that's one thing to consider. Moving on, my takeaways from this analysis, of course, and I intend to do this more periodically, is one thing like we discussed, not many sectors seem to be optically within the value zone, just strictly from a price to earning multiple. Analysts, other investors would say that one needs to look at growth prospects and so on and so forth. All said and done, agreed. But this is one data point which we obviously cannot ignore, more from a broader big picture sector standpoint. Like I mentioned, in certain sectors, like especially defensive sectors, FMCG, pharma, to a lesser extent IT, it's important to compare the current PE multiples to the historic PE multiples because they traditionally seem to be high most of the time. Very rarely you'll find a FMCG company in its lower 30 multiples. So it will not be fair to compare the price to earning multiples of a FMCG company to say something like a cement company, The final point is, of course, that the size of average market cap can reveal smaller companies have hidden value. Like we saw, one company tends to hog the entire limelight, especially if it's a heavyweight. But there could be other companies in the same sector which could be relatively undervalued. And so, even though the sector is doing well and the main company in that sector is doing well, other companies sort of haven't caught that trend. And it might be just worthwhile to consider those sectors as well, right? Um, let's just move on. Now, this final slide talks about, I use the example of Nifty 50 versus Nifty FMCG, but we can do it for any index. And, um, you know, um, if you look at the last 5 years' performance, the Nifty 50 PE has expanded by 68%. That's the red line that you see here. So it was 21 PE 5 years ago in December 2015. It's currently at 36 PE. The Nifty FMCG P levels have remained more or less the same. There's been a 5% uh, expansion, and my apologies, this is 37 and not 27. So there's been a 5% expansion from 37 PE to 40 PE, and whereas the Nifty Pharma has contracted by 39%. Like I mentioned, it was 58 PE 5 years back. It is now down to 36 PE. So it just goes to show that any sector which is the favorite or the darling of the stock market at any given point of time and is commanding a premium valuation may not continue to do so going forward, even for defensive sectors like pharma or FMCG. And I think it's a good lesson and good data point to keep in mind, especially in these heady times when the market just continues to run up and there's a lot of liquidity chasing very few assets. It's probably makes sense to just be a bit more strategic and cautious about the kind of investments we make in specific companies. So I hope you enjoyed this episode of the Dummy Investor. Like I said, please do subscribe to the channel and please do provide your feedback, like the video. Thank you and have a nice day.